Welcome to Iron Financial. Let's just dive right into this. This is the explainer where we help you forge a stronger portfolio, cut through all the market weakness, and identify those bedrock, absolutely ironclad assets that are capable of surviving literally any macroeconomic weather. I am your lead analyst, and today we are running a comprehensive structural stress test on an absolute titan of the retail space. We're talking about O'Reilly Automotive, ticker symbol ORLY, and we are looking for a foundation made of steel, and I'm the market skeptic. Look, we have to be real here. Discretionary retail is bleeding out right now. It's a bloodbath. We are watching legacy brands choke on their own inventory. Margins are shrinking down to absolutely nothing, and foot traffic is dying off as everyday consumers aggressively tighten their belts. So my job in this explainer is to figure out if this company is actually built on solid rock, or if it's just another house of cards waiting for a next rate hike to blow the whole thing over. Is O'Reilly really the impenetrable fortress everyone says it is?
Let me ask you, the viewer, a very direct question. Seriously, think about this for a second. Is your portfolio built to withstand a market crack? Are you holding overhyped assets with inflated valuations that are guaranteed to completely collapse the moment consumer spending tightens even a little bit? Or are you holding real, tangible, foundational strength? Because right now, this market is totally ruthless. It mercilessly separates the structurally sound companies from the completely fragile ones. Exactly right. And we aren't just looking for assets that can merely tread water or survive during a recession. That's not enough for an ironclad portfolio. We are looking for structural dominance. We want companies that actually use market weakness to go on the offensive and aggressively take market share from their fragile competitors. That is exactly why we are putting O'Reilly Automotive under the microscope today. We are going to break down their latest Q1 2026 financial blowout, their historical 10K data, and the core operational steel of their business model.
All right, let me just drop the hammer right out of the gate here. 33. That number represents 33 consecutive years of positive comparable store sales growth. Let that sink in. Uninterrupted growth. Ever since becoming a public company way back in April of 1993, O'Reilly has delivered positive comp store growth every single year. Through the dot-com bust, through the Great Recession, through the global pandemic, and through massive inflationary cycles. Now, 33 consecutive years in the retail sector isn't just rare. It honestly borders on statistically impossible when you consider the standard boom and bust cycles of the average consumer. I mean, nobody does that. But they did, and it is a structural marvel. And what it proves, without a doubt, is that their product is fundamentally non-discretionary. Think about it. When your car's transmission blows up or a fuel pump suddenly dies, that is not a discretionary lifestyle choice. It's an immediate, unavoidable tax on your life. You do not wait for the Federal Reserve to lower interest rates to fix the car you need to get to work tomorrow morning. You fix it immediately. It's structural demand. Okay, let's look at the foundational plans. Section 1. The blueprint. Dual market strategy. Now, every single CEO loves to pitch a dual market strategy, claiming they can somehow conquer multiple, completely different demographics. But what does that actually mean in real life? Are they just trying to be all things to all people? Because usually, when a retail company tries to split its focus like that, they end up mastering absolutely nothing and alienating everyone. While O'Reilly has successfully achieved exactly a 50-50 revenue split between do-it-yourself customers and professional service providers. It's incredibly balanced. But those are two entirely different animals. There is massive operational friction between them. A DIY customer wanders in on a Saturday. They want to browse, ask a bunch of questions about windshield wipers, maybe borrow a diagnostic tool. It requires a lot of patient handholding. But a professional service bay is a different beast entirely. If a mechanic has a vehicle sitting up on a lift, that bay is their core revenue generator. They need a hyper-specific part delivered to their shop in 30 minutes, or they literally start losing money by the minute. Pleasing both of these groups without ripping your operational structure completely apart is notoriously difficult. It is difficult, but they do it through sheer scale and extreme technical proficiency. O'Reilly employs over 825 full-time sales staff who are dedicated solely to calling on professional customers. Think about that investment in personnel. And their regular store personnel are technically trained to assist those high-speed pros, which naturally bleeds over into superior, highly knowledgeable service for the everyday DIYer who walks in off the street. They've built a structure that serves both perfectly. Moving right along, Section 2, Heavy Lifting, the Distribution Moat. Okay, the dual market strategy sounds great in theory, but retail is literally littered with the graves of companies that had great business plans right up until e-commerce giants completely obliterated them. In an era where we are all conditioned to expect everything via overnight drone delivery, isn't a massive physical retail footprint a massive liability? Aren't these guys just sitting ducks for centralized, digital-first competitors? That assumes all retail is exactly the same, which it isn't. Auto parts are the ultimate exception to the e-commerce rule. Auto repairs require immediate, localized fulfillment. A centralized mega warehouse model completely fails when a local mechanic needs an alternator in 45 minutes to clear out a service bay for the next customer. And you certainly cannot wait 2 business days for prime shipping when your car is stranded on the shoulder of the highway. O'Reilly is structurally immune to the Amazon effect specifically because their massive physical footprint is the exact heavy machinery needed for immediate, same-day availability. Let's actually drill down into the cold, hard numbers of this supply chain scale, because it is staggering. At the end of Q1 2026, they are operating 6,644 total stores. That's the front line. The foundation rests on 32 massive distribution centers, with each one housing over 156,000 unique SKUs. But the true operational moat, the real secret weapon here, is the middle layer. 399 hub stores that carry anywhere from 63,000 to 115,000 SKUs each.
Ah, so those hub stores are the actual linchpin of the whole operation.
Exactly. That tiered network is what allows over 95% of their retail stores to receive multiple same-day deliveries. If a local shop doesn't have a rare part, the hub store throws it in a truck and runs it over immediately. The sheer capital expenditure required to build, stock, and staff 399 hub stores across the country is astronomical. It forms a completely insurmountable barrier to entry. This logistical heavy lifting completely locks out smaller independent mom-and-pop jobber stores, and it effortlessly repels the massive e-commerce players who simply lack that crucial last-mile speed. All right, let's put this foundation to the test. Section 3. Stress Test Q1 2026 Financial Blowout. All right. The historical blueprint is nice, and the physical supply chain moat is definitely impressive, but history doesn't pay future dividends. I want to run a real-time stress test on this foundation based on the absolute latest Q1 2026 financials that just hit the wire. Did the foundation actually hold up under the current, brutal macroeconomic pressure we are seeing right now? It didn't just hold, it heavily reinforced itself. Top-line revenue for the first quarter of 2026 came in at a massive $4.56 billion. That is a staggering 10.2% year-over-year growth. Look, beating Wall Street's whisper numbers is one thing, but doing it in an environment where competitors are desperately revising their guidance downward is a massive indicator of foundational strength. When other consumer discretionary retailers are actively warning investors about tapped-out consumers, O'Reilly is literally accelerating. The absolute most crucial metric here is the acceleration in comparable store sales, which measures locations that have been open for at least a year. We see 2.9% in 2024, it climbs to 4.7% in 2025, and then a massive 8.1% pop in Q1 of 2026. Okay, let me push back hard on that 8.1% figure. The source materials clearly mention tariff-driven inflation. Are they just passing significantly higher acquisition costs directly to the consumer and conveniently labeling it growth while their actual foot traffic stagnates? I mean, is this real structural demand or just inflation masking a broader slowdown in the business? It's actually a combination of both, and that perfectly highlights their ultimate leverage. Yes, DIY transaction counts did see some minor pressure, but they possess the absolute pricing power to pass through that tariff-driven inflation entirely. Why does the consumer accept the higher price without walking away? Because the alternative is financially catastrophic. Financing a brand new vehicle right now means taking on an auto loan at 7 or 8% interest. A consumer will gladly absorb a 15% premium on a complex replacement part just to keep their existing, fully paid off 10-year-old vehicle on the road. So the transaction volume shifts slightly, but the ticket value skyrockets, and the consumer literally has no choice but to pay it. Digging into the drivers, we saw double-digit growth in that professional business segment we talked about, and mid-single-digit growth in DIY. But the absolute most critical data point on this slide is the operating margin holding strong at 18.5%. Overall operating income rose 14% to $842 million. Okay, I have to admit, maintaining an 18.5% operating margin while actively absorbing massive supply chain shocks, way higher freight costs, and passing all of it through to the consumer without the business cracking, that is the textbook definition of pricing power. They aren't out there slashing prices just to maintain volume. They are holding the line on profitability like a brick wall. And that operational confidence translates directly into their updated full-year 2026 guidance. They project bringing in between $18.7 and $19 billion in total revenue, pulling in diluted earnings per share between $3.15 and $3.25, and pushing aggressive physical expansion with 225 to 235 net new stores. Now hold on just a second. Scaling physical brick-and-mortar retail requires serious heavy capital. The estimated cost per new owned location is somewhere around $3.2 to $3.5 million each. Committing to building over 220 new stores in a single calendar year is a massive cash burn. Are they overextending their supply lines right into the teeth of a macroeconomic slowdown? Can their balance sheet actually hold the heavy weight of this massive capital expenditure? That brings us right to Section 4, reinforcement, cash and buybacks. Let's look at the balance sheet. This is where I always throw the red flag on these retail plays. The earnings report shows a 16% jump in diluted earnings per share, hitting 72 cents. That looks great on paper, but legacy retailers are totally notorious for masking a dying underlying business by taking on massive amounts of high-yield debt just to buy back their own stock. It artificially inflates the earnings per share metric. So is this real operational strength we're seeing, or is it a debt-fueled mathematical mirage? Honestly, is this just financial engineering? $923 million. That is the massive amount of capital O'Reilly spent in the first quarter alone to buy back 10 million shares of their own stock. And subsequent to the quarter end, they bought another 3.6 million shares for an additional $338 million. Wait, that's nearly $1 billion spent in just 3 months? How on earth are they funding that kind of massive share reduction without completely hollowing out the company's balance sheet? Because it is funded entirely by operational cash. They generated a staggering $1.03 billion in pure net cash provided by operating activities in that exact same 90-day window. They aren't out there leveraging the balance sheet to the hilt. They're simply taking the immense cash exhaust generated from selling auto parts, fully funding their aggressive new store expansion, and then returning the massive surplus directly to shareholders by aggressively shrinking the share count. No debt engineering required. As CEO Brad Beckham stated, "Our ability to drive productivity is the direct result of our team's focus on prudent expense management." And the absolute proof of that statement is right there in the free cash flow margin. It jumped to 17.2% in Q1, up from 11% in the exact same quarter last year. This right here is the cold hard steel in the foundation. Look, you can manipulate EBITDA, you can massage adjusted earnings numbers to look pretty, but you absolutely cannot fake free cash flow margin jumping to 17.2%. If they are converting that much revenue into pure, unadulterated free cash flow, it proves that expense control is a heavily enforced culture over there, not just a slick talking point for analysts on an earnings call. Which brings us to the final breakdown. Section 5. The verdict. Opportunity or trap?
We've stress-tested the 33-year history, we've verified the dual-market blueprint, we've measured the supply chain moat, unpacked the Q1 blowout, and validated the unyielding cash flow mechanics. It is time to synthesize all this data. The visual divergence on this chart is just striking. While the broader retail index suffered massive dips, huge drawdowns, and high volatility over the last 5 years, constantly chopping everyday investors up, O'Reilly's trajectory is essentially a staircase cutting straight upward through all the noise. It visually confirms that their non-discretionary nature allows them to completely ignore market weakness while other retailers bleed out from rapidly shifting consumer fads.
The verdict here is crystal clear. O'Reilly Automotive is an ironclad opportunity. The structural stress test passes with absolute flying colors. Their dual market approach decisively captures both the everyday DIYer and the highly demanding professional mechanic. Their tiered distribution moat, anchored by those 399 hub stores, makes them entirely immune to the Amazon effect. And their ability to organically generate over $1 billion in operating cash flow in a single quarter provides complete immunity to macroeconomic weather. They aren't just a store, they are a financial bunker. They have the pricing power to easily outrun inflation and the massive share buyback program to consistently compound investor wealth year after year. The operational numbers simply do not lie. So the final question goes back to you. Will you reinforce your portfolio before the next market crack? O'Reilly is out there doing the heavy lifting in their supply chain every single day, building an absolute fortress. The question is, are you ready to do the heavy lifting in your own portfolio before the macro environment turns against you? That is absolutely the crucial question to end on. Thank you all for joining us on this explainer. Keep doing the work, keep building that ironclad portfolio, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.